Hi everyone. I'm going to talk about the example I told you I was going to post today. I just got an update on the leaderboard, and so well done to those that made it. That's Liam, Gabby, Rad, Shirley, and Peter. Okay, so on the screen today we're doing a exam question from last year. It covers chapter 15 on non-current assets. So looking at the question here, the first part the whole question is worth 10 marks, and part A, it talks about a scenario here. A business purchased equipment on the 1st of January 2011 for $24,000 plus GST. The equipment had an estimated useful life of 4 years and a residual value of $3,000. The business prepares reports annually on the 30th of June. A. Explain how the accountant should determine the appropriate method of depreciation of the equipment. Refer to alternative methods of depreciation in your answer. So we've learned two methods. One of them is straight line and the other one is reducing balance. Now the question isn't asking you to choose one, it's just asking you what the accountant should think about. So first of all, we should tell the accountant what the two kinds of methods are. Now it just says equipment, it doesn't say what kind, so we don't know if there's moving parts or not. Let's talk about straight line first. So let's say the accountant needs to consider whether the equipment has moving parts and look at its revenue earning pattern. So remember, we looked at that things like shelves that don't have moving parts will expect to generate the same amount of revenue every year and should be depreciated the same amount every year, and that suits straight line. So we'll say that. If the equipment has no moving parts, it is expected to generate the same amount of revenue every year. You can say such as shelves, and the appropriate depreciation method would be straight line. Then you have to explain how straight line works. This means that the equipment will be depreciated the same amount every year evenly. That's 2 marks. The question's out of 4 marks, so now we have to say something similar for the other method. Alternatively, if the equipment does have moving parts, then it is expected to generate more revenue at the beginning of its life and less at the end. This would suit reducing balance method, where more depreciation is allocated at the start of the asset's life than the end, and that's 4 marks. So we need to talk about, a lot of people last year when I was marking, they only talked about that the way it generates revenue. It doesn't actually talk about how much depreciation is allocated. So each method has 2 points. You have to say straight line is suitable for assets that generate the same amount of revenue every year, and then go on to say that therefore it allocates the same amount of depreciation every year. Same with reducing balance. You talk about how it generates more revenue at the start of its life than the end, and therefore you need to allocate more depreciation at the start than the end. Okay, assuming the business used a reducing balance at 30% per annum, calculate the depreciation expense for the year ended 30th of June 2012. So it's told you it's reducing balance, so make sure you use the right method, 30%, and using reducing, let's see, so they bought it in the 1st of Jan 2011, and now it's 30th of June 2012. So doing timelines are useful. So think about that. That's a year and a half. Is it a year and a half? 2 years and a half. So we've got 2011 and So that's 1.5 years. Okay, so let's go. How much did we buy for originally? We said $24,000, so we go $24,000. Now we don't use we don't need to use the residual value or useful life if we've been given a percentage. So we're using a percentage. $24,000 times 30%. Now they prepare reports annually. So for the first financial year, they only had the equipment for 6 months because they bought it in the 1st of Jan. So that means if you look at it like this, so 1st of Jan 2011 until 30th of June 2011, they've only had it for 6 months, right? So you would go $24,000 times 30%, oops, times 0.5. Now that will give you that much, and then for the next year it's for a whole year. So for 1st of July 2011 until 30th of June 2012, that's for a whole year, $24,000. No, now we have to take the carrying value. That's how reducing balance works. So the carrying value by the end of the first year would be $24,000 minus $3,600. So now the equipment is only expected to have $20,400 $20,400 left to be consumed. So the following year, we're going to go 20,400 as opposed to the historical cost times 30% times 1 because it's for a whole year. So a lot of people, if you had continued to use 24,000, that would be a mistake. Now read the question carefully. Assuming the business used the reducing balance method 30% per annum, calculate the depreciation expense for the year ended. They only want the second year. So the answer is 6120. Some people added the 2 up and put 3,000, like how much they've depreciated altogether. That's also wrong. So you need to read the question really carefully. Okay. Looking at the next question, it shows you the balance sheet. And they want to know, I've copy and pasted this, it looks a bit funny, so I'll move it over. So it's meant to be, the equipment is $24,000, they've depreciated $14,000, $4, and there's $9,996 left. And they want to know what the carrying value represents. 2 marks. So you need 2 things. A lot of people were stuck with this one. So what do we understand the carrying value to be? If you say it's what it's worth now, you won't get a mark. So you need to look at your book and look up what does carrying value mean. It could come on your SAC. So you would say the carrying value represents the amount of the non-current asset that is yet to be consumed. So we haven't used it yet, not how much it's worth now. So it's the amount we got left plus something else. Plus what? This is the second mark. Plus any residual value. A lot of people wrote the first part or maybe the second part, and not many people knew to write the whole thing. So that's 2 marks. The amount yet to be consumed plus any residual value. Okay, the very last question, calculate what the carrying value of the equipment would have been at 30th of June 2013 if the straight line method had been used each year. This question has a lot of different things. First of all, they want you to work out the carrying value. That's one thing to remember. You should highlight that if that's important. So carrying value. So don't look for the depreciation or the accumulated depreciation. They want carrying value. And they've changed the date. The last question was talking about 2012. This question's talking about 2013. So that's really important. You need to pay attention to all these things. And they have changed it to straight line method, whereas previously they were talking about reducing balance. So they're really sneaky like that. Let's see. So straight line method's more simple though. It doesn't use carrying value. It keeps using continue to use historical costs. So therefore, we're actually going to go back up. Instead of using 30%, which is for reducing balance, I think a lot of people got stuck and used 30%. That's for the reducing balance. If you go back up here where they told you about the 4 years and the $3,000, that's what we're going to use. So we're going to use the formula. So the depreciation formula is historical costs minus residual value over useful life. And we know that they bought it for $24,000. They were going to sell it for $3,000, and they were going to use it for 4 years. 4 years, 3,000 divided by 4. And at 2013, since they bought it at 1st of Jan 2011, they've had it for 2.5 years. So if we put that calculation in, times, $24,000 minus 3,000 over 4, that's for 1 year. And if you times that by 2.5, that's for 2.5 years. So 1 year, 2.5 years. But remember, what do they want? They want to know the carrying value. So to work out the final answer, the carrying value is what's left. So its carrying value is $24,000 minus what they've depreciated so far, and that will give you the carrying value. Oops. So the answer is $10,000, $10,875. Hope you found that useful.